Hey everyone, my name is Michael Pierre and welcome to Mindful Investing. Today I'm going to wrap up our TA 101 series with some common trading patterns. And once you learn the basics of TA, the rest just comes down to repetition, trying to spot these patterns in real time. And I can't stress enough how important support and resistance zones are, with or without using these patterns, because it is possible to use nothing but support and resistance zones and be successful. This is known as naked trading. But I personally just like to know more about what's going on in the chart. That's why I use these moving averages and so forth. But it really just comes down to your type of trading style, what you like to do, um, as well as if you're doing like say day trading or swing trading, because naked trading really works a lot better on the larger time frames, like 4 hour, daily, weekly. Um, and if you want to do like scalping or these quick micro minute trades, you'd want to use more of these indicators. So it really does depend on how your mind works, and that's why I wanted to emphasize the importance of being a mindful investor. But anyway, we got a lot to cover, so I'm just gonna jump right in. Um, and where we left off last time was, I believe, ascending triangles. So both ascending and descending are going to have a flat base with them. So you're going to see it test this line of support or resistance, one or the other. This is going to be the general shape of it. And you'll see it continually come up on this upward sloping support, as well as get rejected on the line of horizontal resistance, until an inevitable break up or down, which is far less likely, but it can happen. So that's why you want to wait for this zone of support and resistance to get broken right here. So if we were to have a full chart and look back in history, we would in fact see this line right here be historical resistance and or support, because once a line, like say if this did get broken now, it would in turn become support to go higher. And the same with this one. This would be a line of historical support, which if it broke underneath would be resistance. So you'll see it get rejected off this downward sloping resistance, and bounce off that line of support, horizontal support, and then eventually break down. And it loves to go back and retest it to make sure, really. So you'll generally see this get rejected again. So again, this was support in the pattern. Once it breaks, it becomes resistance and gets rejected off of it. And if you'll notice here, this is a double top. So once it broke and you saw it get rejected, test and get rejected off this, now what is called resistance, that would be the perfect opportunity to enter a short trade. And then again here, once it broke and you saw it test back on this now support, which was once resistance within the pattern, once it breaks, it becomes support. Once it breaks out and retests, that will be a perfect time to get in for this long trend here. So that is what we call ascending and descending triangles. So next couple examples I have, I guess I'll get more into what I was talking about here. These double tops, you have double tops, double bottoms, and then even triple tops and bottoms. So they're probably pretty self-explanatory, but you'll see these are patterns you'll see within patterns. So it kind of confirms a rejection or a bounce off of support. So you'll see a trend, and if it starts to run out of steam, you'll see it top out here, come back to this tiny level of support, and it'll tend to retest one or two times. So this would be a double top. One more test would be a triple top. and that is a very bearish signal right here, which it would most likely get rejected and come back down to the next whatever is a large line of support down here in this fictitious chart. So again, you can have the same thing to the inverse. So you can have a double bottom indicating a reverse right here, and then one more would be a triple bottom. So that's all I was talking about, and this can be on really any time frame. It could be on from the minutes to the weeks or months. But they're going to be the most obvious ones, and they tend to play out pretty reliably. So I'll just label that double, triple, top, and bottom. So now I'll put just the time frame. So this ascending and descending triangles are going to be more on say like day chart, or longer, and these can be any time frame. Okay, so the next category are going to be head and shoulders. So this is going to be a little more of an intermediate pattern to spot, but let's see. It can also be on more weeks and months time frames, as well as days or hours, really, but not the shorter time frames like minutes. So the general pattern of this, which sometimes again might be hard to spot because they're not going to be. These are going to be harder. They're not so uniform as the other ones, I suppose. So the general pattern is two shoulders with a tall head right there. So it'll kind of treat this area here as a kind of support zone, and this is known as the neckline. So it'll bounce off this neckline, come to make a higher high, get rejected, come back to this neckline, and so this is the line in the sand right here. So this is actually a bearish indicator. And so this obviously is a perfect looking one, but more likely what you're going to see is maybe like a sideways neckline, or like I don't know, something like maybe even that. So that's why it's sometimes hard to spot them, but that right there would be the neckline. So you would play the break where the price action is. So the break of the neckline would be here, not down here. And again, this can be to the inverse as well, which would be a bullish signal. So you have the shoulder, break of a new low, and then back to the neckline. So this right here would be resistance, and once it broke that neckline, that's a bullish signal right there. So these are head and shoulders. Oh, and one quick one. This can be weeks, months, years kind of time frame, just a rounding bottom, and it exactly what it sounds like. So you're just gonna see it kind of just do something literally just like that, a rounding bottom. And yeah, that indicates a macro bottom, say like maybe a multi-year bull run. That's where that pattern would show up. Alright, so the last category that I wanted to cover is going to be the wedge patterns, and these again are on the longer time frames, maybe like weeks and months, maybe not quite years, but yeah, maybe like days to weeks, or more like days to weeks, I suppose. So the psychology Well, it kind of, let's see, it has two converging trend lines. That's the best way to say it. So, two trend lines that are coming toward each other to a point, and they rarely meet, but it just means that like in a what's it called, a falling wedge. This is actually a bullish indicator. Might be opposite of what you would expect, but it just means the downward pressure is just getting worn out, basically. So you'll see these steep drops and spikes respecting both of these converging trend lines. So again, this is support, and this is, oop, I got that back. You'll get those mixed up a lot. So resistance, so it's literally resisting the price from going farther, and support right here. So again, these are generally long-term, 3 to 6 months, but generally not longer than that. And then, so a rising wedge, so at the top you would see more that it's just like these tiny price movements. So especially if you're seeing this pattern unfold over the course of weeks, and the volatility is kind of fizzling out here, that's when you want to set up your trade. Maybe play a break of this line of upward sloping support somewhere around there. I don't know. But these are pretty common wedges. So bull and bear. And remember, it indicates a movement to the opposite of this trend. So that is all the patterns I wanted to cover. I just had a couple of notes, or I guess like an important, not quotes, but just ideas to remember when you're trading. So I have a list here, 30 habits of highly successful traders. I'll only read the most important ones. So number one, actually is the most important. Wealthy traders are patient with winning trades and enormously impatient with losing trades, and more importantly, they never add to a losing trade. So you hold on to that winning trade for as long as you think is logical, but with the losing trade, you get out as soon as possible. You do not hold on to a loss. So the most important thing in trading is mitigating your losses. Another very important one, they stop trying to pick tops and bottoms. So do not ever try and think like you want to wait for this break. You don't, if you see this pattern unfolding, you don't get in until it's broken the pattern every time, because these patterns can always get negated. That's the biggest thing. And I can't tell you how many times I've tried to pick a top or a bottom and failed miserably. So yeah, if I could point out honestly anything on this list, it would be that one. Do not try and pick tops and bottoms, because even if your method is right, you can be wrong time and time again, because you're just not 100% accurate, and you have to be 100% accurate to pick a top and a bottom. So it's just not realistic. So another one, very important, is you have to know, even before you enter the trade, know the price that you want to exit at. So, just completely random chart. If you're getting in right here, and none of this has happened yet, but there's previous price action indicating that this might be a zone where it's going to stop, know that that's where you're going to exit. So the reason for this is because, you might see it go past that, and the greed kind of kicks in, and you just want to see where it's going to go, and then suddenly it just reverses and you lose everything. So it's never worth that extra couple percentages. Just know when you're going to get in and out before you even enter the trade. So you don't have to be making a million trades to be successful. 1 or 2 trades a month makes a successful trader's month. So that also means that you can lose 5 trades within that month if they're very, very small losses. So if you're only getting 1 or 2% loss on a trade 5 times, that's what, 10%. And if you, 1 or 2 trades, that could be 20, 30% per trade, and that is it. So even if you're losing more trades than you're winning, if you have a good strategy to mitigate your losses, that is the most important thing. So that's those are the most important ones I want to keep on here. I won't make this video too long, but yeah, I would honestly suggest still looking up these patterns. Maybe get just a definition written down, that maybe write one yourself that makes total sense to you, and yeah, just start trying to spot these patterns in real time and write down where you would make a trade. Don't make the trade yet, and just see how successful you get and how make those marginal improvements, because that's the best way you're gonna mitigate your risk and still get some skin in the game, even though it's not going to be the same. You're not going to be in the same mindset unless you actually have money in the market, but it's a good place to start for sure. So yeah, I'm just going to cut it right here. Thank you for watching, and we'll catch you in the next one.